Welcome to Vskills YouTube channel. In this video, you will learn about the top interview questions for merger and acquisition. So, let's get started. Question number 1. How do you value a company as a professional? The answer is, when valuing a company as a going concern, there are three main valuation methods used by industry practitioners. 1. DCF analysis. 2. Comparable company analysis. 3. Precedent transactions. These are the most common methods of valuation used in investment banking, equity research, private equity, corporate development, mergers and acquisitions, leveraged buyouts, LBO, and most areas of finance. Question number 2. Given the case of an acquisition, what would you consider, the equity value, or the enterprise value? The answer is, equity price reflects the market value and fundamental value of company. It is essential to consider the enterprise value in case of acquisition, since the enterprise value is an indicator of the company as a whole. Question number 3. Can an organization have a negative enterprise value? The answer is, yes, an organization can surely have negative value. Given a company is on the brink of bankruptcy, it will have negative enterprise value. Adding to this, if the company has large cash reserves, enterprise value will swing to the negative side. Question number 4. Given the FCFF, calculate the FCFE? The answer is, FCFF plus tax on EBIT minus actual tax paid minus interest on cash, net of tax, minus interest on debt plus repayment of debt equals to FCFE. Question number 5. What discount rates will you go about using? The answer is, let us suppose if you are doing a DCFF, then you would use a WACC. Since it accounts for both debt and equity capital in the cash flows you are discounting are pre-financing and do not already include interest expense. But if you are doing a DCFE or a DDM, then you would use just the cost of equity since the cost of debt has already been taken into account in the cash flows that you are discounting. Question number 6. Can you spot the difference between asset beta and equity beta? The answer is, the asset beta is the unlevered beta which holds no risk to the leverage, which the asset may hold. On the other side, when the beta is calculated by looking into the beta of other company, you obtain your levered beta. The mere thing left to do is to delever the beta. Question number 7. How's a merger different from an acquisition? The answer is, in any M&A deal, there's always a buyer and a seller. The difference between merger and acquisition is more semantic than anything. In an acquisition, the buyer is significantly larger, whereas in a merger the companies are close to the same size. Question number 8. What is a cogeneric merger? The answer is, generic means in simple words, generally meaning the same. Thus, cogeneric merger is when two companies belonging to the same or related industry, but producing or dealing in different products merging to form a company. Let's say, a professional or producer bats for the game of cricket, and a company producing only baseball bats merge to go global with their bats. Question number 9. What is a reverse merger? The answer is, it is when a private company, to automatically become a publicly traded company, it buys a public company, and it does not have to undertake initial public offer. Sort of like a roundabout way to become a public company without the actual hassles and costs of IPO and other initial formalities that a public company has to compulsorily adhere to. Question number 10. Why would an acquisition be dilutive? The answer is, an acquisition is dilutive if the additional amount of net income which the seller contributes is not sufficient to offset the buyer's foregone interest on cash, the effects of issuing additional shares and an additional interest paid on debt. Also, acquisition effects, such as amortization of intangibles, can also make an acquisition dilutive. Question number 11. A company with a higher PE acquires one with a lower PE. State whether is this accretive or dilutive? The answer is, you can't tell this unless you also know that it's an all-stock deal. If it's an all-cash or all-debt deal, the PE multiples of the buyer and seller don't matter because no stock is being issued. Sure, generally earnings more for less is good and is more likely to be accretive, but there's no hard and fast rule unless it's an all-stock deal. Question number 12. Why would a strategic acquirer typically be willing to pay more for a company when compared to a private equity firm would? The answer is, you can't tell this unless you also know that it's an all-stock deal. If it's an all-cash or all-debt deal, the PE multiples of the buyer and seller don't matter because no stock is being issued. Sure, generally earnings more for less is good and is more likely to be accretive, but there's no hard and fast rule unless it's an all-stock deal. Question number 13. In an acquisition, why do goodwill and other intangibles get created? The answer is, the value over the fair market value of the seller that the buyer has paid are represented by these. By subtracting the book value of a company from its equity purchase price, you calculate the number. More specifically, things like the value of customer relationships, brand names and intellectual property, valuable, are represented by goodwill and other intangibles, but not true financial assets that show up on the balance sheet. Question number 14. In merger models, how are the synergies used? The answer is, revenue synergies. Normally for the combined company you add these to the revenue figure and then assume a certain margin on the revenue. This additional revenue then flows through the rest of the combined income statement. Cost synergies. Normally by this amount you reduce the combined COGS or operating expenses, which in turn boosts the combined pre-tax income and thus net income, raising the EPS and making the deal more accretive. Question number 15. What is a successful acquisition? The answer is, a successful acquisition is the one that increases the market price of the acquirer's stock over what it would have been without the acquisition. Acquirers in the most successful deals have specific, well-articulated value creation ideas going in. For less successful deals, the strategic rationales, such as pursuing international scale, filling portfolio gaps, or building a third leg of the portfolio, tend to be vague. Question number 16. What is a vertical merger? The answer is, if you see the chain of the distribution, there is a producer, then the wholesaler or agent, retailer, buyer. If an oil-producing company purchases the company responsible for distributing its products, then it is vertical merger. Or a jet manufacturing company purchases the company producing the tires it uses on its jets. Question number 17. What does it indicate if a company go private? The answer is, leveraged buyout, LBO, indicate if a company go private. A leveraged buyout, LBO, is the acquisition of another company using a significant amount of borrowed money, bonds or loans, to meet the cost of acquisition. Question number 18. What is horizontal merger? The answer is, two companies which belong to the same industry merge is known to be a horizontal merger. For instance, if Airtel and Reliance merge, they belong to the same industry, telecommunications. Question number 19. When restructuring should be undertaken? The answer is, the restructuring of a firm should be undertaken in case the restructuring is expected to create value for shareholders. Restructuring is the corporate management term for the act of reorganizing the legal, ownership, operational, or other structures of a company for the purpose of making it more profitable, or better organized for its present needs. Question number 20. What is a target valuation? The answer is, target valuation is the valuation of the target company, the one that will be bought, by the acquiring company, that is, the company wanting to buy. It is the value of the target company as a whole defined in financial terms, the worth of the company at present and the benefit it will continue giving to the acquiring company in the future. It is the very first thing one sees in any M&A. Question number 21. Effective control of a firm requires approximately how much % of ownership? The answer is, effective control of a firm requires approximately 20% ownership. Question number 22. What do you mean by issue management? The answer is, issue management refers to identifying and resolving the issues that might arise in a project. The issue management team designs a set of procedures which need to be followed when an issue arises. Issue is a situation which arises during the control or execution stage of a project and which was not identified during the planning stage. The issues that may arise need to be resolved or they might hinder the success of the project. Question number 23. In which type of merger a completely new firm is built and both the acquiring and the acquired firms cease to exist? The answer is, consolidation or amalgamation is the merger and acquisition of many smaller companies into much larger ones. It is a merger in which a completely new firm is built and both the acquiring and the acquired firms cease to exist. Question number 24. If Microsoft were to acquire US Airways, the acquisition would be classified as which type of merger? The answer is, it would be classified as a conglomerate merger. It is a merger between firms that are involved in totally unrelated business activities. It is any merger that is not horizontal or vertical. In general, it is the combination of firms in different industries or firms operating in different geographic areas. Question number 25. In an asset purchase, could you get deferred tax of liabilities? The answer is, I don't think so. Because in an asset purchase the book basis of assets always matches the tax basis. They get created in a stock purchase because the book values of assets are written up or written down, while the tax values are not. Question number 26. Discuss the various factors influencing the valuation of a company. The answer is, firstly, the nature of business in which the company is involved and history of the business. Secondly, the economical benefits of the business in general and how good it is in the specific sector in which it is involved. Thirdly, the effectiveness of the management and its strategies. Fourthly, value of assets and liabilities of the company and the financial status of the company. Fifthly, the capacity of the company to earn. Sixthly, the capacity of the company in paying dividends. Last, the goodwill of the company and its intangible assets. Question number 27. What are the reasons for cross-border deals? The answer is, there could be many reasons for a firm to decide on a cross-border M&A like. First, technology-seeking M&A. One of the main reasons why a company decides on a cross-border M&A could be that it wants to develop its technology and it feels that the target company has the desired technology which will benefit the production scheme of the acquiring firm. Second, market-seeking M&A. Another reason why a company could decide on a cross-border M&A is to expand its market to international level. In such cases, the company would look out for a company which is already established in the market where the acquirer firm expects to increase its market share. Question number 28. Explain financial instrument. The answer is, financial instrument is a document that represents a legal agreement involving some sort of monetary value. Financial instruments can be classified generally as equity-based, representing ownership of the asset, debt-based, representing a loan made by an investor to the owner of the asset. Foreign exchange instruments are also a type of financial instrument. Question number 29. Name the different types of due diligence. The answer is, 1. Legal due diligence, 2. Tax due diligence, 3. Operational due diligence, 4. IP due diligence, 5. Commercial due diligence, 6. IT due diligence, 7. HR due diligence. Question number 30. Throw some lights on the key lesson of M&A. The answer is, 1. Merging should be done only if it is a part of the strategic plan of a company so that they know what they are doing and why. 2. It is necessary that a right partner is chosen for an M&A and it is for the right reasons that the merger is carried out. 3. If a company feels that a merger would not be beneficial or if it feels that there could be certain issues which would remain unresolved, then it should walk away from the deal. 4. If careful planning is done on the front end, a lot of pain can be avoided in the later stages. Important to be prepared for various changes. 5. It is necessary to spend adequate amounts on the consultants and advisors. For more such videos, subscribe to our channel.